Now you'll notice in the top panel, we have triggered a short-term sell signal. And that does suggest that upside prices or movement to the upside is likely going to be limited somewhat in the near term. Now, that doesn't mean we have to have a major correction, right? We could just sit here and trade sideways for a month or two, work off this overbought condition, work off that sell signal, trigger the next buy signal and move higher. It could also mean that we have a little bit more of a correction here.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and Adam Taggart, welcoming you back here at the end of another week with my good friend, the Even Steven portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing great this morning. It's Friday. It's been kind of a trying week. So it just, one of those weeks where it's just like everything hits at once. And I need to have a conversation with the big man upstairs and say, look, I can handle all this stuff. Can we just space it out a little bit? Give me 2 things a week, not 10. But other than that, it's all great.
All right, thanks. There must be something in the air. I've had a little bit of a week like that. But in your case, Lance, let me remind you of the lessons from the Stoics that we talked about at the end of last week. Just try to apply those. And also, when you have to have that conversation with the big man, you've got that big church tower right next door.
Yeah, like I said, like I told you before, it's been if you weren't here, I was talking about my new office, and I'm still under construction, by the way, and I'll have to give you a tour once it gets all finished. But right outside, I have this glass window that overlooks the backyard, and it also there's a big, massive Catholic church that directly backs up to my house, St. Giovanni. And so when I look out every morning, I see this giant steeple with a cross at the top of it. So it just reminds me to be a good boy during the day. So
I was going to say, yeah, I've noticed your language has gotten a lot cleaner since you've made this move. All right, well, look, I started with Even Steven because last night I checked out Polymarket, which is that betting platform. And one of the things they allow people to bet on is the presidential election. And wouldn't you know it, they've got the odds here at a dead heat. 50-50 right now. So it looks like, we're going to have a nail biter unless something happens to blow this race out. Quite honestly, I'm kind of rooting for a widening here one way or the other, just so we don't end up having our regular, conniption fit on the night of the election, not knowing who won. And then, of course, all the craziness that can come after that. So anyways, we're deadlocked right now. I know you've said that the market doesn't care all that much about the presidential election, but you have said that it could de-risk leading up to the election and then maybe pop coming after the election. You've just written a piece, I believe, that kind of looks at what you think might happen depending upon who wins. Do we want to start there?
We can start wherever you want. I mean, today we also had the big employment number out this morning that was much stronger than expected. I mean, there's so many things that we can talk about. I wrote an article on Tuesday talking about the everything market because we have this environment right now where literally everything is going up. And it's fascinating to me because, if you talk to, stock market guys, well, it's going up because earnings are great and earnings are doing good and the economy's doing fine. And that's why stocks are going up. You talk to, a bearish guy. He's like, well, gold's going up because of the debt and the deficit. So that's why gold's going up. If you talk to a cryptocurrency guy, it's like, well, we just had the halving. So that's why, Bitcoin's up 54% this year.
Right. And oil's going up because of the wars. Yeah. I mean, it's just, there's a reason for anything. Yep.
Yeah. But what's great about this is that no matter what your thesis is, the market seems to be proving you correct because everything is going up at the same time. And that really should not be the case. And so we kind of went on Tuesday, kind of going through, a lot of these different, kind of structures and looking at a market, but the big risk and the takeaway from that article was simply is that no matter what your thesis is, the problem becomes when everything is correlated, which everything has now gone to a correlation of 1. A good example is gold has almost a 90% correlation to stocks right now, which historically is something you find at both market peaks and gold market peaks as well. So, it's the problem becomes when everything's correlated, when something happens and it causes a shift in sentiment, there's no safe place to go. You're already in everything. Dividend stocks are going up. Real estate, utilities have had a huge run this year. So there, normally your safety trade is to move into defensive areas of the market, but those have had a huge run. So, you just got this really interesting environment where everything is going up all at the same time. Everybody feels like they're right in their thesis. The problem comes, as we've seen before, is that when something changes, all of a sudden, all that falls apart and those correlations kind of just go crazy. So, it's going to be interesting to see what happens from here.
So, correct me if I'm wrong, but I feel like we've seen this movie recently. I mean, as recently at the end of 2001, right? And then we went into 2022, and that correlation maintained, which meant that everything went down.
Yeah.
Stocks went down, bonds went down. There was pretty much almost no place to hide. I mean, gold kind of hung in there, didn't go up. But people, the lesson from that recent experience should still be in our minds, but it doesn't really seem much to me, does it?
No, and because again, we're human beings, right? And so, set everything aside for a moment and let's just go back and talk about the very basics of investing and the thing that investors do wrong consistently. And look, I do this too because I'm human and, I have emotions and I have psychology and all these type of things. But, when asset prices are going up, we just start thinking they're going to continue to go up forever. And again, when the asset price is confirming our thesis, well, now we're even more right and more convicted to that trade. And so we start committing all these psychological and behavioral problems about portfolio management. And then when things reverse, we're still convicted to that thesis, and we don't realize that asset prices are now changing for another reason, and we haven't migrated to there. So we start making all kinds of other decisions. So this is why investors consistently buy high, they wind up selling low. They chase, last year's hot performing assets versus what's going to be performing next year. The old, kind of Wayne Gretzky, go to where the puck's going to. But these are the same mistakes that investors make over and over and over again, which is why historically investors underperform the markets by such a large margin over time. In fact, there was a really great report out earlier this week that shows the average performance of retail investors underperforms the overall market by almost 8% over the long-term kind of time frame of the market. So they just consistently make the wrong decisions that impair their market returns.
Sorry, is that 8% a year?
No, on average, kind of. So if the market's up 10 or 12, they're generally up, 3 or 4. And this is just, and again, it's not every year. These are averages over time, but there's a fairly big gap between the long-term historical average return for investors versus what investors actually make. Dalbar does this study every single year as well. They've got some great analysis on investor psychology, lack of performance, those type of things. And when it comes to investing in stocks, there was another really great report out this week that showed that out of all the stocks in the market, only 30% of them actually outperform the overall index, as the other 60% underperform. So even a challenge for an investment manager and a portfolio manager is trying to pick the 30 stocks that are going up, more than the markets. And, again, this is where we get back into, psychological problems where we go, well, that stock's underperforming, so I'm going to hold on to it because hopefully, someday it'll play catch up. And if I get back to even, it'll do great. The story behind the Everything Market article earlier this week was simply that if you own a stock or an investment right now, whatever it is, and it's not performing, you need to get rid of it, because if it's not performing in this market, there's a very good reason why it's performing, and you need that. That's one I would look at and go, man, this market's up 21% this year, gold's up 25%, whatever it is. This asset is either negative or up 2 or 3. That's where you look at it and go, okay, I'm going to get rid of that because there's a fundamental reason why that's not performing on a risk equal basis, right? So I mean, you can't take a no risk asset and compare it to a risk asset. But if you're comparing apples to apples and you've got something that's severely underperforming, let that go. That's one of your basic rules. Sell your losers. Let your winners continue to run. But focus on risk management in the portfolio, taking profits, migrating more of your portfolio to assets that are performing with the markets, and then hedging the risk that something will eventually change, because it will.
Okay. You did a great job of delivering like all the caveats I usually offer, of course, across the course of this like hour and a half video right up front. So that's awesome. But I do just need to feel I got to repeat here for folks. All the reasons that Lance just listed there are why most retail investors benefit from working with a good professional financial advisor who tries to help protect them from the worst of the behavioral mistakes that retail investors tend to make, but also to help them put the structures in place to hopefully not underperform the market by that much on an annual basis every year. All right, Lance. So we'll get to the Trump Harris article you wrote in a bit. Let's stick for a moment on this theme of the everything market, which I know that's your term for it. I think I've heard many people call it the everything bubble, certainly leading up into 2021. We'll find out if that's the case here or not. But one of the things that I just wanted to state for regular viewers of this channel is that, like Lance has observed, I'm seeing an increase of the number of experts come on this channel whose outlooks are shifting bullish. So these are folks like Louis Gove, who I just had on, Jan Van Eck, who runs the Van Eck family of ETFs and funds. These are people with their fingers in many pots around the global investing landscape, and they are becoming increasingly bullish, at least in the near term. Jim Carson, had said, "Hey, look, even though I think volatility is going to increase, I can make a case, and I think it's my default that the stocks are going to basically run up through the end of the year." Wolf Richter, Lance, you've been looking at the technicals for us, and up until we're going to find out, but up until now, at least, they've been bullish, and we've still been in the bull channel. So I want folks to note that shift in tenor, just calling it for what I see it. And the reasons that they cite, are understandable. Right now we've got, and this is different compared to a month and a half ago. We've got the U.S. now having pivoted, right? We have China firing both its monetary and fiscal bazookas. We have the ECB that's already been cutting interest rates ahead of the Fed. So we have the world's largest economies now all officially easing, right? All officially adding liquidity back into the pool. When we talk to Michael Howell, and folks, I'm going to have Michael on the program again, and I think like a week and a half, he pretty much, says, look, I hate to say it, folks, but it's generally all about liquidity, and liquidity is continuing to rise. So there's a lot of data-driven arguments to be bullish at this time, more so than there were just, like I said, about a month and a half ago. So we just have to be aware of that, right? Now, to Lance's point, when everything's going up like this, trees don't grow to the sky. Valuations have been stretched. In many cases, they're getting more stretched right now. So it's all this stuff we have to be careful about. But let me just mention two things, and I'll let you respond to all this, Lance. Jan Van Eck said, his strategy here is to diversify amongst equities. So, a lot of the market's been highly concentrated, in the Magnificent Seven, the big tech. That's actually been underperforming relative to a number of other sectors right now. And so Jan is basically saying this is a time to, not sell all your Magnificent Seven, but to start taking some of that capital and putting it into some of the other elements of the equity spectrum that have been unloved. Emerging markets, very bullish on, and those have done very well of late. Commodities, Bitcoin. He's not so favorable on longer term bonds, Lance, so that might be one area where you and his outlook differ. He says stay on the short end of the curve. Louis Gove is pretty similar, has a pretty similar outlook to Jan. And the piece of the puzzle that he added the other day was that Chinese stocks got so low. I think we might have even talked about this really briefly in the wake of my interview with Jesse Felder. They've gotten so low that it was kind of like blood in the streets valuations for a lot of assets, just like ridiculous PE ratios, especially when you factored in the cash that some of these companies had or were kicking off. And Jesse Felder had said, look, I know the prevailing sentiment about Chinese stocks is that they're uninvestable. And he said, it's hard for me to even think about owning any. but he's like, this might be a blood in the streets moment. And I kid you not, Lance, like a week and a half after he said that, the Chinese stock market erupted. And of course, that's because China started doing massive stimulus again. And that's all being done basically to restore confidence in Chinese markets, restore confidence in the Chinese economy. And so, I think Chinese investors now feel like, hey, we've got a Bank of China put here. And that's one of the reasons why money is really beginning to flow back in. And so the knock-on effect of that is that Chinese investors have trillions parked in assets in the West. And he's saying what we're beginning to see are capital flows from West to East, where Chinese investors are taking some of the capital they have in Western assets and now beginning to allocate either domestically within China or within other countries, that are regional in Asia there. And so that's probably some of the reasons why emerging markets have outperformed the NASDAQ 100 of late. But he thinks that that's going to be a driving trend for the next at least 12 to 18 months. So we have these different cross currents going on here. How far this goes, what happens from here, I don't know. I just want to note all this to say that a lot of this stuff is quite new compared to what we've been talking about for most of this year. And I want to make sure investors, it's on their radars.
The markets have been pretty clear over the last year and a half that more of the bearish concerns, the recession concerns, et cetera, weren't really there in terms of, the economic data didn't support it to a lot of degrees. And yeah, we had some signals where, inverted yield curves and things like that certainly have had a long track record of predicting recessions, and they can certainly have a lag effect before they take hold. And I'm not saying that we're not eventually going to have a recession, because we will, but, the problem is always with this is that, when there's a lot of really bearish commentary and a lot of negative sentiment, that's generally a great environment for stocks, and stocks have performed well because they climb this wall of worry.
Yeah, bull markets climb wall of worry. I do want to note, though, there was a lot of data there that was recessionary, and this is a game of trying to estimate where the puck goes, and sometimes you look at the bad data, but the bull market climbs the wall of worry, and sometimes it doesn't. So, my point here is just, there were certainly reasons to be concerned about the data. Now, to your point,
yeah,
a lot of things may have happened in the background that undid this, including, rising liquidity. Like, this rising liquidity is definitely going to continue to push off some of the shoes that folks maybe thought were ready to drop. That's one of the reasons why I'm bringing it up here.
Yeah, no, that's what I'm saying, though. But, the liquidity push is not this. And all I'm trying to make clear here is that this liquidity push didn't start last week. It's been going on since 2022, or actually.
Oh, sure. Yeah, this is just another big bucket that's getting poured in. Yeah.
Yeah, exactly. So no, and it's not even that big of a bucket. What we've got going on, and again, I disagree with the premise that, China is going to extract trillions of dollars out of U.S. markets and pull them back. There'll be a little bit of that. There's a reason that Chinese citizens keep their money out of China, because they're a communist country. And what they know is that any day the government can show up and go, yeah, you're in jail and we're taking your assets, just because they didn't like something that you said or something that you did or whatever. They don't have to have a reason, but they can confiscate everything you own. This is why Chinese investors, they like gold. They invest in real estate outside the country. They move their assets out as quickly as possible in a lot of cases, and they store those assets outside China boundaries because of that concern of confiscation. Emerging markets, yeah, they're performing a little bit better here lately because of what's going on in China. That's going to probably be fairly short-lived. In fact, we may have already seen the peak in that whole kind of Chinese stimulus policy in the short term. But emerging markets have underperformed everything over the past 12 years. So, if you've been investing in emerging markets for the past 12, 14 years, you've severely underperformed domestic stocks by a large margin. That's simply because the domestic S&P 500 makes up 60% of the global stock market. So again, all the asset flows in the world are primarily moving to U.S. stocks. Global flows into U.S. stocks is extremely elevated, and we have the largest inflows into U.S. ETFs ever on record right now.
So it's all true. Let me just ask you this to see if it's something that gives you pause. TBD on how much capital currently parked in the West will go east, right? I think you and I can both say, hey, sure, some of it will probably move. We don't know how much yet, at least from the China factor. What's your level of concern with the Japan factor, where if Japan, with the new prime minister, actually does continue to support a strong yen and the carry trade becomes less and less viable? Again, there's a lot of Japanese assets that are invested in a lot of things because of the carry trade that might come home to Japan saying, oh, yeah, the game there is over. May as well bring my money home.
Well, Japan's pretty much given up on trying to hike rates now. Interesting commentary out on that yesterday, because they understand what the consequence is going to be, is that if they try to hike rates too much, the impact to their economy is going to be pretty much devastating, particularly when every other country is cutting rates. So, remember, the whole world works on two flows. One is interest rates and currency. That's how the world works, because it has everything to do with trade. So if my currency is too strong relative to another country, I've got, look, if I'm the US and our currency is extremely strong relative to every other currency in the world, then the Federal Reserve is going to step in and try to bring that currency back down into a balance so that trade can be executed. Because again, if a currency is too strong or too weak, it impacts the ability for consumers to spend money or for companies to export product because of the imbalance of price. So interest rates are the same thing. If interest rates are too high in one country, then that's going to attract inflows into their currency because they want to buy their bonds, right? So if the Japanese government tries to raise interest rates, they'll attract huge inflows into the JGB, the Japanese bond, pushing the dollar higher, because that's or the Japanese yen higher, because that's basically pushing money into their reserves, which now impacts their ability to control trade and hurts their economic trade deficit relative to the rest of the world. So it hurts their consumers, hurts their GDP ultimately. So again, so Japan's starting to realize this. Japan's been in the trap for 30 years. And they're trying to figure out how to get out of it, but you can't, because at 230% of debt to GDP, you're stuck at zero interest rates. You cannot raise interest rates in that environment.
So I get all that logic. I don't think any of it's new, meaning, like, I think everybody knew this for years, right? And certainly going into this election.
Look, I'm going to credit John Malden here. John Malden was talking about Japan being a bug in search of a windshield back in, I think, 2001 or 2002. So, this has been a concern for 20 years, right?
Right. So I guess my question here is, so the yen really weakened against the dollar over the past year, right? So I believe it's still kind of at historic lows. Or near historic lows. The new prime minister, I'm forgetting his name, it begins with an I, but Ichiba, I think that's it. He was one of the more hawkish candidates for PM. So he just got elected. One would think that he would have a mandate to continue to be hawkish and strengthen the yen. Are you just saying, nope, I mean, literally, hate to use the analogy, that was just kabuki theater to win the election, but everybody knows this and nothing's going to change? Like, are you basically saying, don't worry, carry trade's here to stay?
Well, no, first of all, yeah, the carry trade's here to stay for a while, because again, it's just, the economics make it very difficult for Japan. Look, could Japan hike interest rates? Absolutely. They can do anything they want. The problem comes with the economic consequences of that. And at some point, you've got to defend your economic stability relative to the rest of the world. So it may sound great in theory that I'm going to hike interest rates to the moon, but again, the economy can't stand that. And that's kind of the same problem we have in the United States. Everybody's talking about, well, interest rates are going to go so much higher from here because of the debt and the deficit. It can't. Because if interest rates go up, our cost of funding accelerates and basically causes economic devastation, which drags interest rates lower. So we are Japan 20 years removed. I mean, we're in that liquidity trap where we're stuck to the point where, in order to have liquidity, we have to maintain low interest rates. We've got to keep interest rates within a level that allow for liquidity to operate within the system, because if interest rates go too high and become too restrictive, the entire system will basically shut down, because consumers can't afford anything, governments can't afford anything, companies can't afford anything, so everything retreats, which immediately acts as a deflationary pressure on the entire economy, bringing rates back down again.
Okay, but this is instructive though, because we talked about purchasing power of currency decreasing many times in the past, and I believe that is why Prime Minister Chiba had the mandate that he did, which is because the yen, basically what happens is when your debt burden is too large, eventually the casualty of that is the purchasing power of the currency. It's one of the reasons why the yen has weakened so much against the dollar. Now, cost of living, they're having their own cost of living, consumer inflation problem in Japan. And I think that is what has been putting pressure on the leadership there to strengthen the yen, right? So are you basically saying that Japan is so much further along us that they are in, what's the term? Fiscal dominance, where basically all that matters when you get into fiscal dominance is keeping the debt serviceable. And basically the central bank has to give up its inflation fighting mandate. It's just like, all we got to do is just make sure that things still work tomorrow. And if we got to kill the currency as a result of that, sorry, everybody, but we can't let the credit market cease, because then the economy ceases to function. Like, are they already there?
Well, no, but remember, they can't kill the currency either, right? And because, again, my currency has to be relative to another currency. And again, this is the fallacy of, people saying, well, loss of purchasing power in a dollar, blah, blah, blah. That's inflation. We talked about last week. But I have to maintain that currency balance to some degree, because again, if I look, and again, we're talking about major economies, Japan, Europe, China, et cetera. Emerging markets are a different story. Zimbabwe is a different story. They're not a major trading partner. But major trading partners have to maintain some type of stability between the currency, because it creates a tremendous amount of problems when it comes to economic growth, stability of economies, et cetera, like that, kind of et cetera. Because again, everything's based on trade. We're a global market these days. We're not a shut-in country that's just all trading within ourselves. We trade with everybody else. And for us, and particularly in the US, we're so dependent upon trade stability because we outsource so much of our labor and our goods. We export our inflation so we can import deflation. Well, if we allow our currency to collapse, then the inflationary difference between our currency and say China or whatever it was that would have a massively stronger currency would just absolutely devastate the economy. So that can't be allowed to happen. And that's why whenever things start getting out of whack, and it always kind of makes me laugh when people talk about, well, China's manipulating their currency. Yeah, so do we. We've been manipulating our currency since 1920.
Yeah.
We do that to maintain economic stability, because, and this is why you'll see when something kind of starts to go wrong, the first thing the Fed does is open up currency swap lines with other countries. And that's to keep currency somewhat stable, so you don't have a currency collapse of some sort, because that would just cause an economic disruption.
A contagion, yeah.
Yeah, and not just across the economic markets, but it also gets into the financial markets as well. Don't forget, there are literally trillions upon trillions upon trillions of dollars of currency swaps out there hedging trade.
Okay, so really all I'm trying to get to here is, because I feel like Japan is getting boxed in, maybe even more so than the Fed, right? That it's having to make decisions, not necessarily because it wants to, but because it has to try to preserve these currency relationships, right? Both with international trade and domestically.
Absolutely.
So I guess the question is do we expect in the relatively near term, let's say the next year, the prime minister, whether the policy there is to have to be more supportive of a strong yen that could impact the carry trade, not necessarily kill it, but diminish it, or is it something not to worry about? That's really all I'm trying to get to. Do we need to keep tracking this going forward, or can we say no, this is not a worry?
Look, there's always a worry. We saw what happened when the carry trade kind of blew up in August, and that was very minor, by the way.
A minor blow up or a minor blip in the carry trade?
it was a minor blip. I mean, we worked off some of the margin, but remember, there's a $20 trillion carry trade sitting out there. So, I mean, the carry trade is absolutely gigantic, and it's across all assets. That carry trade's being pushed, and this is another reason why you're seeing the everything market, which is all that liquidity and primarily all that leverage is driving every asset price higher. And, and this is, and as I kind of go through that article, I lay out and say, look, it's simply a function that you have too much money chasing too few assets. And, if you take a look at, for instance, gold as an example, gold production has fallen for the last 5 years. So you've got less production of gold and you've got more dollars chasing a lower production of gold. Take a look at stocks. In 2000, we had over 8,100 publicly traded companies. Today, we have about half that, right? Just barely more than 4,000 publicly traded companies. So we've completely, shuttered the supply of investable assets, and yet we've created a massive amount of money through leverage, through stimulus, through government interventions, through bond issuance for the Inflation Reduction Act and the CHIPS Act and all this other stuff. Is just trillions upon trillions of dollars that are chasing a smaller number of assets. And that's why assets and you talked about earlier, just talking about liquidity, the three things that drive a market is liquidity, liquidity, liquidity. And we have just an absolute, kind of tsunami of liquidity chasing a smaller number of assets. So assets continue to rise, and we keep trying to come up with reasons why and again, sure. Could the Japanese carry trade blow up in the next year or two? It's entirely possible. It depends on what decisions that the Japanese government makes. But I think at some point there's a reality check that says we can't do that, because if we do that, they're going to get a tap on the shoulder from other central banks as well, saying you can't do that. But I think there's going to be a reality check that comes in from either their financial markets, their economy, their voting base, whatever it is, that says we can't tolerate this action, whatever it is. And again, this is why Japan for 30 years has just been in this continual grind lower, this deflationary push. They've got, aging demographics. They've got this massive debt structure that's sitting out there. They've got a massive pension problem. And by the way, we have exactly the same issues here. Okay.
Last week we pulled up a chart, a historical chart of the cyclical adjusted PE ratio, the CAPE ratio.
Yeah.
And you showed how basically over time, over the decades, the average PE ratio has risen, right? And some might argue productivity, a number of different arguments, but could a very simplistic one just be your point, which is we have a lot more money and we have fewer companies fewer stocks to put that money in?
Yeah, no, I mean, there's a lot. Well, first, economic growth has grown, then, there's, inflation issues and all that. But yeah, just a lot of it is that investors have become trained, so to speak, to pay higher valuations. And, it's no longer a function when you're looking at 23 times earnings that you're going, wow, that's really expensive. Mike and I were just going through a whole long list of stocks, yesterday, just kind of looking through portfolios and looking for new ideas. And it's amazing how many good quality companies are trading at 50, 60 times earnings that are basically slow growth companies. They don't really, if we were 20 years set back from here in the late 90s, we look at those companies and say there's no way those earnings growth rates are going to support a valuation. But we now have a tremendous number of companies that are trading at some of the highest valuations that they've ever sported. The market in general, kind of across asset classes, are all trading at very high valuations. But that, again, to your point, is just that investors, that there's so much money that are chasing these assets and they've got to get them invested. And remember, this is a key point. As a retail investor, you don't have to invest. You can put your money into a bank account somewhere and sit on it and collect your money market interest, and you can be just fine. But if I'm a hedge fund, a pension fund, a mutual fund, an ETF, portfolio manager, whatever it is, I have to invest that capital, either by mandate. In other words, if I'm a private equity investor, I've got to invest that capital, otherwise I have to give it back, right? So I don't want to do that because I get paid on that invested capital. As a mutual fund, I've got a mandate that I have to have 90% of my money, 95% of my money invested. If an ETF, 100% has got to be invested because I'm just an ETF. I'm a passive ETF. So if you give me money, it goes into the underlying stocks. And if I'm a portfolio manager like me, I've got to keep money invested because I have to perform with the markets, because if I don't perform with the market, I suffer career risk. Even though I may be doing the right thing by the client, by saying, Mr. Client, we're keeping 50% of our money in cash right now because we're really worried about valuations. That argument may last for a month, maybe two. But if this market keeps rising, they're going to go, Lance, I hear you, but I'm missing out too much on the market. I got to go somewhere else. And those assets leave to go to another advisor that is willing to take that risk and perform better. So, outside of you as an individual retail investor that can make that decision to be in cash, all the other money out there, and it's trillions of dollars, doesn't have that option. And so that just keeps pushing money into markets.
Right. And one thing you didn't mention there, which is another big player, is the giant mindless robot, right?
Well,
pardon me?
That's the ETFs.
Well, yeah, it's the funds going into the ETFs. So basically, that's a monthly inflow that, as we've talked about, is by definition price insensitive. It is not, you can actively determine whether to buy or not. It is just, I'm giving you these funds every month. They're coming out of people's paychecks. You have to put them in the funds that the 401k has specified, right?
Yeah.
So
the indexing flows are absolutely huge. The active ETF flows have just absolutely surged off the charts over the last 2 years. There's just been a massive flood of money into active ETFs. But again, just everywhere you look, it's just, and I was kind of actually talking about this on the radio this past week. It's amazing how much money is out there. You kind of look around, it's like, where's all this money coming from? Because it just keeps showing up. You would kind of expect that, there would kind of be a limit to where everybody will have invested everything. And then when you think we're to that point that everybody's potentially invested everything into the markets, there's just more money showing up right behind it. And it's just pretty incredible.
Yeah. And I don't have clarity into the specifics of that. Is that just back to our pig and the python analogy? Was the pig just way bigger than we thought and there are parts that are still coming in? Is it, current fiscal stimulus that's just continuing to shovel money in here? Is it funds coming from the rest of the world into the US because we're performing so well? When you're in the US, you have the high quality problem of, when you're doing well, everybody wants to be playing at your poker table, right? So let me ask you this, Lance. We've gotten to none of the questions on my sheet here for the day.
But just real quick, I'll stop here. The answer to your question was yes, all of those.
Okay, so thank you. But this has gone in an important direction because I think we're putting our finger on kind of like a core question that most of the viewers of this channel are asking themselves, if I'm interpreting correctly from people's comments, which is, so is this just the new normal, right? Is this just the way it is? And historic ratios of, price to whatever, does that stuff not matter? And we're just at this permanently new high plateau. And this is just the way it is going forward. And I've got to, the Dr. Strangelove line, right? We got to learn to love the bomb. I got to learn to love this new market. Or, is there a worry here that, trees don't grow to the sky at some point in time? It will be so distorted from market valuations. I think you were even talking about some of the distortions last week, that there is kind of a reckoning point you have to worry about. So yes, you might still need to play the game while it's going on, but it's like living in California. You just know at any point in time, we could have the big one at any minute, right?
Right. But it hasn't happened in 50 years, right? When I was growing up in the 70s, right? Everybody was like, oh, just, any day there's going to be a giant earthquake that goes along the fault line and California's just going to fall off in the ocean. 50 years later, you're still here, right?
Right. Well, but let me continue that analogy because it's instructive. So if you look at cities like Berkeley, they're on the Hayward Fault, and they run this documentary out here in California every few years, and it always puts the fear of God in you when you watch it. but they show kind of aerial. Yeah.
I think I saw that documentary. That was San Andre Fault with The Rock, right?
Yeah. Yeah, yeah, pretty much. And look, I hope this thing doesn't, just to be super clear, I hope the fault stays asleep for my entire lifetime and then some. But if you look at aerial photos of the Hayward Fault, when they were developing Berkeley, you could see they were very respectful. Like, we're going to build on one side of the fault or the other side of the fault because we know there's this fault here that has a higher risk than most of the other faults of breaking at some point in time. And then you can see as sort of like we got into the tech boom and the real estate boom starting in the 80s, 90s here in California. They just said, screw it. We're just going to, we're going to build wherever someone's willing to, plunk down a building. And that strategy has worked for them so far, right? But if that Hayward Fault were to shift, the destruction is going to be catastrophic because they have kind of thrown caution to the wind in terms of where they place their buildings, right? So I think it's actually a good analogy for my question, right?
Yeah.
Which is, what type of environment do you think it more is? Which is just, hey, this is the new normal, and folks, you just have to get comfortable with it, or no, this is a market that kind of has this sleeping risk in it, and I don't know if it's going to happen tomorrow or 10 years or 20 years from now, and we just got to play the best we can, with an eye to the fact that at some point this thing could rip.
Yes, the market is overvalued. Yes, the market is stretched on there's a lot of reasons to expect that this market will correct at some point, but that point could be 5 years from now. It could be 10 years from now. It could be another 20 years from now. If we look at secular bull markets in general, they typically last somewhere between 18 and 20 years, which would put us right now for the end of this current secular bear market around 2028, 2030. So, another 5 years. But that would be normal, right? That'd be a normal cycle. But we haven't had this cycle is not normal because of all this liquidity flow that we've had coming in. Interestingly enough, right now we have more easing and financial support since 2008. The only period that's had more financial support and liquidity right now was only 2020. That was the only other point in time where we had more easing and financial support than we do here. And right now is equivalent to what we saw during the financial crisis when everybody was panicking. And yet there's nothing wrong, right? The credit spreads are fine. There's nothing wrong with the credit markets. There's nothing wrong with the banking system. There's nothing wrong with the economy. But yet we've just got this massive spigot of liquidity and financial support turned on, and it's only got one place to go. It's got to go into assets. So if your thesis is I'm going to sit in cash because I think the world's going to end tomorrow, you're going to miss out on a lot of potential to make sure your purchasing power parity of your dollar is sustained. And, and this is when we go back to talking about the loss of purchasing power. That's when you talk about the loss of purchasing power of the dollar, that's just your relative purchase power of that dollar versus inflation. So you have to make sure that your rate of growth of your money is growing faster than inflation to maintain your purchasing power parity. And that's why,
as you've said before, stocks is like one of the best assets that has protected against inflation versus all asset classes.
It's the best over the last 130 years, just by a long shot. So
yeah. And just to be clear here, so I'm not trying to push back on anything you're saying. I'm just trying to help the viewer understand your outlook on the markets, on this era that we're in the markets. And what I'm hearing from you is, yeah, you got to get used to the fact that valuation ratios are higher now than they have been historically. Because it's understandable. A lot of people will say, look, I'm looking at the data. We've really distanced ourselves or forgetting the right word here, deviated. We're really deviated from historical means and medians. I'm really uncomfortable investing in that type of market because I feel like reversion to the mean on a lot of these core ratios, mathematically should kick in. And I hear you saying it really might not, or it really might not until there's some breaking point, but we have no idea when that's going to be. And it could be so far off in the future that if you just play it too conservatively now, you're going to actually injure yourself more over the long run. The whole Peter Lynch, more money was lost, planning for the next break than actually happened in the break itself, right?
But so, and look, so that's right. So that's the important lesson, right? Is to focus on the markets and what's going on, and trying not to let our psychology override our investment process, right? And so this is why, like, we actually have in our office a written investment process that we follow. It starts with the fundamentals, moves to the technicals, and gets us down to where we're selecting stuff. Where we make our mistakes is when we deviate from that process. If you have a good, strong investment process that is disciplined and focused and rational and repeats itself consistently, you will be a better investor because it strips out all this other stuff, right? It strips out all the headline news, employment number out today, right? Okay, so employment came in much stronger than expected. That probably means the Fed's not going to hike, cut rates by 50 basis points in November. There'll be 25 basis points, right? So whatever it is, but that's just one piece of headline data, and it may move the markets today, but that's not what's going to drive markets longer term. But there's certainly risk, and I don't want you to walk away from this conversation with me and Adam that nothing is wrong with the market. This is a long-term chart of the S&P 500 going back to 1975. And then, now, importantly, this is a monthly chart, so it moves extremely slowly, right? Because it uses end-of-month data. So this is through the end of September. And what you'll notice is that every time the market historically has been this overbought, that's the top panel, relative strength, has been this overbought. And again, we're not as overbought as we've been previously. So this market could continue to go higher and get even more overbought. Before.
Sorry to interrupt. Can you just expand this while you're talking about it?
Let me make it larger.
Yep.
Oh, sure. Absolutely. I always forget because I'm on a different monitor now than I was before. Is that better?
That's better. Thanks.
So the top panel is relative strength. So again, we're now above 70, which is technically overbought, but historically we've been higher than that. And being overbought can last for a while. It can last a lot longer than you think. The bottom panel is the moving average convergence divergence indicator, the MACD, and that measures kind of the distance between two moving averages. And again, that's very elevated right now. The deviation from the long-term 4-year moving average, where three standard deviations, almost 4, above that long-term moving average. So historically, whenever you've gotten here, we can go back through history and say, look, there's been decent corrections. You had the crash of 87, you had the dot-com bubble, but again, it didn't happen right away. It took a couple of years to get there, but eventually you're going to get a reversion. So we are going to have a reversion to the mean at some point. The problem is it, and again, this is a monthly chart. So on a monthly chart, you're looking at this is years between 1998 and 2000, right? It was 85 to 87. It was 2 years. It can take a while before you get there. And again, the market can go up a lot higher before you eventually have that correctional process that occurs. Here's another chart. This is gold. There's only been 5 other periods in history that gold has been this overbought. It's 4 standard deviations above its long-term moving average. Its MACD is extremely elevated. Its RSI is above 80 right now, which is extremely elevated. But every time you've had gold being at this level, you've always gone through a corrective process. It too, like every other asset, will revert to the mean, but this is all a function of liquidity and money. This is our monetary policy conditions index. This takes a look at interest rates, the Fed funds rate, the short-term treasury rate, the long-term treasury rate, the dollar, and everything else that affects monetary policy. Now this chart's inverted. So you see, as financial conditions are easing, then that's beneficial towards higher asset prices. And you can see right there, just recently, there's COVID. And then you can see where the market bottomed in October of 2022. Monetary conditions were very restrictive. And since then, this market's taken off running because we've had this big reversion in monetary conditions. Monetary conditions have continued just to become easier and easier, and that's driving higher asset prices. So again, what we're fighting here is that whatever your thesis is, and this is the whole conversation, is that whatever your thesis is, you're being proven right by rising asset prices because you have a massive amount of money chasing every asset, not just one asset.
So glad you brought it back to that, and just stay in this chart for a second here. So we've had a big move recently. You can see it right there at the tail end of the liquidity chart. But when you're looking at kind of the historic range here over pretty much since the start of the new millennium, we're really like the midpoint. In other words, this tide of liquidity could keep rising for a good while before it even gets close to an extreme. So again, this is why I wanted to start with the shifting outlooks of a lot of the folks on this channel, and the reason for those outlooks and liquidity being a big one is because if you were real worried about a lot of the fundamental data a month ago, you can't ignore this right now, because this flood of liquidity, if it doesn't heal a lot of wounds, it might just push them off far enough in the future that if you're taking overly bearish positions right now, that might not work out well for you.
Right. Again, this is my point to you, is that this didn't just start, recently. You can see that downturn where monetary conditions tightened up momentarily. That was last year when we had that 10% correction in the market last summer. We had monetary conditions tighten temporarily there. But then since then, obviously the market's doing fine and we've had the reversal. So conditions are coming back up. But again, this monetary shift occurred back in October of 2022, when we were in the middle of that correctional process with Russia invading Ukraine, the Fed hiking rates. Monetary conditions got very tight, and that caused that correction in the markets. And again, at least right now, that's behind us, and this flood of liquidity is continuing to push, asset prices higher. And this is what I was talking about a second ago. This is the chart of monthly global central bank policy cuts. We haven't had this many policy cuts since the financial crisis, right? The only one outside of this is March of 2020. So everybody is on board right now with stimulating markets, but yet there's no crisis, right? Every other time there's been a crisis. This is the fascinating part to me, is what do central banks see that the markets don't see at this point? Or are they just in a position that we've got to do this because we all hiked rates and now we're paying the consequences of higher rates, so we've got to get rates back down so we can get the economy to start to function the way we want it to again, and be able to issue debt and kind of go on our merry way? Whatever's going on is happening. But every central bank is now on board with cutting rates.
Okay, so I want to get to talk about the payrolls data in a second, because it does potentially slow the Fed's ability to do rate cuts the way that the market was thinking it might just yesterday, right? Versus yesterday, because the payroll numbers came in so darn strong. So we had these blowout payroll numbers. What they came in at 254,000, beat the highest estimates. So much so that the unemployment rate dropped. I think it's like 4.05%. They're still calling it 41, but if we go down a couple hundredths of a percent, it's going to be a 4.0 handle. So you combine that with the jobless claims that we got earlier in the week, which remain very low. Continuing claims are tabletop flat again. So there just doesn't seem to be any real trouble in the labor market based upon this official data. And I'm going to put the huge asterisks out there, is that we have, lambasted this official data for a long time, and they have made wild revisions to it that we've already covered a lot in this channel. But if this is an important part of the data set that the Federal Reserve is navigating by, it makes it really hard to justify aggressive rate cuts from here, we'll say. I think there definitely were a lot of people earlier in the week saying, I think the Fed might actually cut another 50 basis points. I can't imagine that at all next time around, right?
No, CME's already cut. If you go to the CME, you can look up the Fed funds futures contract. And this morning, as soon as that report came out, the odds of a 50 basis point rate cut just evaporated.
Yeah.
It's like 9% now. It'll be a 25 basis point cut.
Yeah, which is understandable. So question to you, Lance, is, so what are the knock-on effects of this? If all of a sudden the Fed has to slow its roll on interest rate cuts, what knock-on effects would you expect to see in the financial markets?
Well, so first of all, let's have one caveat here, right? Nobody cares about and this is when I say this is the ubiquitous term of you, right? So when I'm about to say the term you, I'm not talking about you as Adam. I'm talking about you as in you, me, everybody, right?
Yep.
The market doesn't care about your view on the labor market, and you can sit around with your tinfoil hat on and say it's all conspiracy, it's all made up. All these numbers are a lie. Market doesn't care. What the market cares about, and the only thing they care about, is the headline number. They don't even care about the revisions, right? So we just saw this 800,000 job revision, of the jobs numbers over the last couple of years. Market was like, yeah, whatever.
Hit a little indigestion, and then that's ancient history. Yeah.
Like I said, it's like Don DeLuise and Gumbo Rally. What's behind me is not important, and that's the way the markets look. Markets are forward looking, and so today's number, it should have been a real negative for the markets, right? So today was kind of an interesting day coming in, because if the number was really way too strong, that would suggest that really the Fed shouldn't cut rates at all, really. And that's what this number today said. If you take a look at the number of foreign-born workers declined, the number of native-born workers increased. I mean, this was a strong jobs report right across the headlines. There was nothing bad in this report other than multiple job holders hit an all-time high. That's the only real negative, but everything else was great. So if I'm the Fed, if I'm truly data dependent, if I'm truly the Fed, I would be saying right now, it's like, I'm not cutting rates in November. There's no reason to cut rates here. Now, the Fed wants to get rates down to where inflation is. So where there's a big gap between where the Fed funds rate is right now and where inflation is. And so they want to bring that down to get Fed funds in line with inflation. So there's going to be some more pressure for them to cut rates. But it certainly doesn't argue for a 50 basis point rate cut. The other side of this coin was it came in super weak, and the Fed would have to go, oh my gosh, maybe we're closer to a recession than not. Maybe we better cut 75 basis points, right? So there was this kind of this thin line where the report came in 150, 175. It's like, okay, good, we can cut 50 basis points. We're all on track. Well, it didn't. It came in a lot hotter. So the markets opened up pretty strong and then sold off once they kind of realized now the Fed's not going to cut rates 50 basis points. And I think that's going to continue to kind of weigh on the markets. So, the markets are very dependent right now on the Fed's cutting rates. We're about to kick off earnings season next week. And I just posted a chart out on Twitter this morning. We've had a massive reduction in earnings estimates going forward for the third quarter. So we'll have a high beat rate as usual. It's millennial earnings season. Everybody gets a trophy. But this is going to put more pressure. The slower the Fed cuts rates, estimates for forward earnings are going to have to come down some more. So that may start to put some pressure and at least some concerns on markets near term of the valuation issue, and maybe asset prices don't rise at another 20% next year like they have over the last 2 years.
Right. Well, in theory, if we, I feel like this is such an old-fashioned way to think about the markets. But if we think about the markets as a projection of earnings over time that are then discounted back to today, the models yesterday were probably using a lower discount rate going out than they are today, right? So in theory, asset prices should adjust down as a result of that, right? Now, the markets haven't really worked this way for a long time. So I know I'm probably setting myself up for disappointment thinking this way, but that really is sort of what should happen. So it'll be interesting to see. Markets are still up as we're talking here, but not nearly as much as they were going forward. There was another thing in the jobs report I just want to mention here too, which is that we saw wages go up. Which on one hand, you can cheer and say, okay, great, workers, that'll help people deal with cost of living. On another hand, you might say, well, all right, that kind of contributes to inflation, right? Some people are beginning to say, hey, did the Fed actually make a policy mistake by cutting by the 50 basis points last time? Did they cut too soon? Is inflation not completely dead here? We've seen some other blowout numbers too. This ISM services PMI was a big beat this week. It was an 8 sigma beat. But here's something that was commented on that. So chief business economist at S&P Global Market Intelligence, Chris Williamson, said, the inflation signals from the survey point to reviving price pressures, principally linked to stubbornly elevated wage growth, which could temper the Fed's enthusiasm for future aggressive rate cutting. So this data came out prior to the payroll data we just got today. Could sticky, stubborn inflation here, be a bigger problem here than the markets have come to expect? Because the markets, I think, had gotten to the point where it was like inflation, that thing's pretty much all but dead.
Well, I mean, I think inflation is going to be stuck here between, say, 2.5% and 3%, somewhere in that range. I think that's really possible. So again, the Fed, that's what I'm saying. The Fed's got to get their rate down. They're at 4.875 now, so they got to get down, a good bit down towards 3%, just to kind of align with inflation. But it's interesting. There's actually, this is also another one of those indicators that, really just tells you there's no risk of a recession right now. So this is the ISM composite index. So this is a composite index of the manufacturing and services, and it's economically weighted between services and manufacturing. Manufacturing today is 20% of the economy versus 80% in the 70s. Services are 80% today versus 20% in the 70s. So if we economically weight that 80-20 services to manufacturing, we're in expansion mode, and there's never been a recession when the economically weighted composite is in expansion mode like we are right now. Mm-hmm. And this also kind of ties over into, kind of this other interesting conundrum. This is the annual rate of change versus the ISM composite index. Now, there should be a fairly high correlation between asset prices and the ISM composite weighted index, because the economy is where earnings come from. But interestingly enough, asset prices are way ahead of what's actually happening. The economy is not growing all that strong. It's growing okay. We're running at 2.5%, but the market's acting like it's growing at 4%. So, that's going to be an interesting issue again when this comes back to earnings. And as you made the point a second ago, earnings are extremely important to the overall driver. This is forward earnings estimates versus the S&P, and so not surprising markets track forward earnings. At some point, we're going to have to start to ask the question: does forward earnings, ratchet down to the point that individuals become, market investors become really concerned about what they're paying for asset prices? This is the estimates for Q3, going back to their first estimate in March of 23 for this quarter. It was at 220. We're down to 202. So we've cut estimates almost $18 a share to go into earnings season right now. So again, we'll have a high beat rate for earnings, but really, what are you paying for? And what you're continuing to pay for is a lower rate of earnings growth than what you originally thought you were paying for to start with.
Okay. All right. Look, beginning to look at the time here. I want to make sure we knock through a couple of additional important stuff. But this is something I'm sure that you're watching really closely, Lance, right?
Yeah.
Can we then pull up the near-term chart of the S&P here, and can you just give us the quick read on where things are right now in the markets? I mean, you put up the great series chart from 1975. Showing where we are, but what are the current technicals about where we are this week telling you?
This is crucially important. So again, we talk about these kind of macro ideas, right? It's like, oh, this is a problem, that's a problem. Look, yes, wage growth was stronger than expectations this month, but it was weaker than the growth rate from last month. Wages are declining. Wage growth itself is declining. So wages are getting cut back. Companies are figuring out how to pay less wages to their employees in order to protect their profitability, because they have to offset, higher inflation or higher taxes. And this is,
sorry to interrupt. I should note that I think in this latest report, the wages went up, but hours worked went down, right?
Wages went up, and you cut and the reason wages went up is because that's a function of how many hours you're working, right?
Right.
So hours keep getting cut. But importantly, this all kind of plays out into the future at some point. Again, so these big macro issues are certainly there, but again, timing is so incredibly important. And that's the thing as investors that we've got to really focus on, is making sure we get our timing right. Because again, I can be right. I can be super bearish and be all in cash and be in cash for 10 years. And eventually I'll be right. There'll be a major correction. I go, aha, I was right, but I missed 10 years worth of gains, right? So our goal as investors, and Howard Marks said this the best, is like, you can be early but that's still the same as being wrong, right? So we have to manage our risks for what we have in the markets today and what's going on. Now, there's certainly some short-term concerns in the markets. In this weekend's newsletter, by the way, if you know, I've started posting on Substack now. So if you go to @Lance Roberts, I'm posting daily market commentaries and stuff over there. So come give me a follow. It's all free. I don't charge like that.
Do you have a preference of where people go, or just whichever platform they prefer?
I don't care whatever platform you prefer. It's fine. You can come to our website. You can go to LinkedIn. You can go to Twitter. I post everywhere. So if you're on Substack and you want to follow some of the stuff we're doing over there, I post there too. But so in this weekend's newsletter, I'm actually going through 3 bullish and 3 bearish setups for the market short term, right? So 3 bullish indicators, 3 bearish indicators. And what that basically means is I have no idea what the market's going to do next month, right? But we have to just understand what those risks are so we can manage our portfolio accordingly. So this is a chart of the S&P 500 right now. So very bullish trend at the moment. We see this consistent pattern of higher lows. That orange kind of rising trend lines, very bullish. Markets came down yesterday and we touched right on the previous July highs of the market. That was support. It's also about where the 20-day moving average is. So that's that red line. So we came down and touched those levels of support, bounced off that today, which was good. Now we're selling off a little bit. But as long as we're holding above those support levels, the market can kind of continue to just kind of grind sideways here and kind of work off this overbought condition. Now, you'll notice in the top panel, we have triggered a short-term sell signal. And that does suggest that upside prices or movement to the upside is likely going to be limited somewhat in the near term. Now, that doesn't mean we have to have a major correction, right? We could just sit here and trade sideways for a month or two, work off this overbought condition, work off that sell signal, trigger the next buy signal and move higher. It could also mean that we have a little bit more of a correction here. And so if we take out that rising trend line, which is right there, you know, if we intersected it today, it'd be kind of right there at 56.72-ish, about where the 20-day moving average is. If we take out that line, that's going to suggest a correction back to the 50-day moving average. Below that's the 100-day, which is kind of those lows of September. And then the 200-day sitting there at the lows from August. So there's certainly some downside risk that, you know, we should certainly be well aware of. But there's only 27 days now till the election, something like that. Whatever risk we're going to have in the market is likely going to be contained to this 27-day period. So we may see this market trade sloppy over the next month. Not a lot of gains, maybe not a lot of losses, you know, unless something, you know, unexpected happens and like major war breaks out between Israel and Iran overnight. That could certainly be an issue, but nothing's going to really, you know, pretty much dominate the market in the short term until we get past the election. Now, once we're past the election, we're going to be through about 80% of earnings season. Buybacks will be back, right? They're off right now. So buybacks are in a complete blackout at the moment. Earnings season starts in earnest next week. We got all the major banks next week, regional banks next week. After that, week after that will be Apple, Microsoft, Google, all those guys. So by the time we get to the end of the month, we'll have 80% of all the earnings will be in. So we'll know what earnings season looks like. Buybacks come back and you'll be past the election. So we'll know pretty much what the outcome of the election is. And then markets are going to start to factor in whatever the expected policies are. So if Trump wins, and that's the premise of today's article, if Trump wins, what sectors are going to benefit the most under him? If Harris wins, what benefits the most under her? And markets will start adjusting for that. So again, correction period, potentially consolidation over the next month, and then rally into the year end. Target for year end rally right now is around 6,000.
Okay. And I was going to ask you if you'd mentioned that last week, and I was going to ask if you see anything that makes you want to revise that. Sounds like no. Let's quickly.
That's just a technical target. The technical analysis says that's the target. It doesn't mean we have to go there. It just says that's the potential target.
Right. But the conditions you saw last week haven't changed materially.
That's correct.
Yeah. Okay. If we can, because we said we talk about it, let's very quickly talk about the key takeaways from that piece you just wrote. And then if folks want to get the real details, they can obviously go to, well, now your website or your Substack to read it. And then I want to get to a few other quick things before we get to your trades and then wrap up.
Yeah. I'll just move real fast through this. This is just investment policies under Trump. Obviously, he's very big on, bringing back oil and gas production. If you listen to the debate between Vance and
Waltz.
well, thank you. I drew a complete blank. He kept coming back and really talking about this, making America energy independent, et cetera. And, crude oil exports have continued to rise. We continue to be energy dominant. So, basically, if Trump wins, you would expect a return back to that. Obvious winners are ExxonMobil, Chevron. From the drilling side, we like Diamondback Energy. By the way, there's a disclaimer at the bottom of the page. Most of the stocks that I talk about in this article are stocks that we own. So just understand that I am talking my book here a little bit.
People say you're talking your book, you'll say yes.
Yes, I am, because this is how and the purpose of this article is that we basically positioned our portfolio right now for whoever wins. We don't care who wins, we should benefit from it. Defense and aerospace should do well. We own Raytheon Technologies, but Lockheed Martin would also do well. Obviously, as defense spending continues to rise, this chart right below it is obviously defense spending versus aerospace and defense stocks. The more money we spend on defense, that money goes somewhere. So, companies like Raytheon and Lockheed Martin, Boeing, Boeing has other issues, which is why we don't like them. But Lockheed and Raytheon have been very good performers and should continue to be performing as long as we're continued to be involved in, military dysfunction around the world.
So I got to ask you this, right? Sorry, these are opportunities if Trump wins?
Yes, we're under Trump right now. So this is all
okay.
Trump.
So Trump is I didn't start any foreign wars under my last administration. So I'm just curious, wouldn't you expect him to maybe have less support for the defense sector than a Harris administration?
No, because the defense spending increases in Democratic and Republican administrations.
Okay, so this is almost like a deep state. Doesn't matter who becomes president. Eisenhower's military-industrial complex is going to get its pound of flesh. Okay,
exactly. So that's going to, and again, the defense companies have the biggest lobbying arms. So remember, this is all about lobbies at the end of the day.
Okay.
The Trump election also, of course, he's talked about cutting taxes and moving back restrictions imposed by Dodd-Frank, et cetera. So JP Morgan Chase, we own that. Goldman Sachs, we own in the dividend portfolio. Truist Financial, we own in the dividend portfolio. PNC Bank would also be another beneficiary. So financials should do well. And interestingly enough, financials typically struggle when the Fed is cutting rates, but we've now moved in this environment of liquidity and everything else is going on that even though the Fed is cutting rates now, financials are continuing to do better because now they're going, okay, well, that's reducing the net interest margin for these banks, which is going to make them more profitable. So banks are benefiting from the idea that the Fed will cut rates, and that, of course, help stabilize some of the regional banks as well. So we've liked the regional banks for a while. We've been invested in regional banks really for quite some time. But we also like JP Morgan, Goldman Sachs, et cetera, because of their investment banking decisions that they do, and they also tend to be the biggest kind of investors of capital. So from a Harris opportunity, so if Harris wins the election, then you got to kind of focus over on kind of clean energy and sustainability. So companies like NextEra Energy, First Solar, Tesla, would obviously be a good benefit there. Now, we don't own any of these companies in particular. We do own some companies that are in the green energy space, but none of these in particular right here. Also, healthcare and pharmaceuticals. She'll want to obviously, further drive the Affordable Care Act into the system. Even though the Affordable Care Act is continuing to make healthcare even more unaffordable for people, this is, the whole idea of government control over healthcare is what is kind of a really ingrained into the Democratic platform. They really want to control healthcare as a function, because if I can control healthcare, I can control the economy for most part. So beneficiaries from that would be Pfizer, Johnson & Johnson, United Health Group. Pfizer's been really beaten up over the years, but I think there's and particularly last year was under a lot of pressure. But I think coming out of this cycle, and again, I'm not making a recommendation on anything, but Pfizer could be one of the better beneficiaries coming out of this in terms of a price. But it's already had a big move here just lately. But normally after in election years, healthcare tends to struggle. After election years, they tend to perform a lot better because there's clarity on kind of what the regulatory environment's going to look like for healthcare stocks.
Right, and that is a top expenditure of the U.S. government, so money is going to continue to go in there. Yeah.
This is personal consumption expenditures in healthcare versus the healthcare sector. So again, everybody's spending more on healthcare, so that's going to continue to go up. Technology and innovation, obviously NVIDIA, Microsoft, Google, we own all those stocks. But again, there's going to be this continued push for technology, demand for electricity, for artificial intelligence. That's going to push utility stocks. And it's interesting right now because everybody hated utilities in real estate last year. Now they can't get enough of them. So a lot of these stocks have already moved a lot. So you're going to have to wait for corrections and pullbacks to support to add to positions. We recently just added to like our NVIDIA and our Amazon positions because they had pulled back, held support, and now they're kind of starting to play a little bit better here. But you have to just kind of be opportunistic about adding positions to the portfolio. Now, just real quick, nothing comes without risk. Tax policy uncertainty is a risk. Interest rate and inflation risk are certainly still there. Both administrations are going to face managing inflation and trying to control rates. So there's always, if the economy really starts to fire on all cylinders because of all the liquidity, then inflation is going to come back, and they're going to be having to struggle to deal with that. Healthcare sector volatility is going to be, problematic as well. New healthcare regulations could compress margins for these companies. CVS, other companies have been struggling for a long time, so we'll see what happens there. So again, none of these investments come without risk. And again, I agree with your guest talking about diversification. This is why, if you take a look at our portfolio, we have holdings really kind of across both areas. So whoever wins the election, the portfolio is well diversified. We own stocks that are defensive. We own stocks that are offensive. We own stocks that are dividend paying stocks. We own stocks in aerospace, defense, healthcare, artificial intelligence, pretty much everything where companies are growing earnings, fundamentals are strong, and they're recipients of liquidity from ETF investing in particular. In other words, they're in the top 10 holdings of ETFs. So we capture those passive flows coming in. Diversifying, building income into your portfolio, that can certainly help a lot. Like, for instance, we own Procter & Gamble and Coca-Cola as well as others. But then also, most importantly, you've got to follow your risk management discipline. Just because, this is the idea going into the election doesn't mean this is how any of this actually turns out. So if something, if something changes, we're going to have to adapt, to that as we go forward.
All right. And just to bring it back to the image I showed at the very beginning here, many different sources you can use. I just use Polymarket because it's not a poll, it's an actual betting platform where people are putting money down, have no idea if it's any more or less trustworthy than the polls. And trust me, after tweeting that out, had a ton of people saying, I can't believe you believe polls, and it's all just to, influence us. And hey, it's probably very true. This is just simply a betting market and what it's predicting. And as of right now, it's a total dead heat, right? So it could go, easily either way, at least according to them. All right. So real quick in there, you talked about how, utilities have caught a huge bid this year, and it's largely because of AI. We're going to just need to produce more energy going forward. The energy sector itself, that had underperformed for a while. How is it doing right now?
It's doing better. So we've owned ExxonMobil and Diamondback Drilling for a long time. We've taken profits in it numerous times. But oil's been under a lot of pressure over really about the last 6 months or so. And again, there's an interesting setup right now. Just technically, I like the setup for energy here short term.
Okay, that's where I was going.
Yeah, so stocks they've already had a decent run. FANG's up like 10% in the last 3 days because of Israel, Iran, shooting missiles at each other. But we have one of and again, look, when it comes back to anything, whether it's a commodity, gold, stocks, it doesn't matter. Pick Bitcoin. It's all about supply and demand. Thesis, again, as I said before, theses are great. It has nothing to do with the market. What drives price is supply and demand. And if you have more buyers than sellers, prices go up. You have more sellers than buyers, prices go down. And particularly when it comes to commodities, specifically in commodities, it's all about the futures trading on the NYMEX. That's what sets the price. So if I'm a producer of oil, right, and I've got 5 million barrels of oil, I go to the NYMEX market and I buy calls or puts to hedge my production so I can sell my production at some point in the future. But all that trading, whether it's institutional or speculative, is all what's setting the price. It's all done on the futures market. And that's why one thing I look at more than anything else is short and long positions on various commodities. So if I want to know where oil is potentially going to trade or where gold's going to potentially trade, 6 months from now or a year from now, go take a look at net short, net long positioning, because if you have a huge net short positioning, like you have the largest net short position on oil right now in like 5 years, that is a massive amount of fuel. If prices move enough, and I think it's going to be somewhere between 78-ish, maybe 79, somewhere around there, you're going to trigger a big short squeeze, and that's going to push oil prices higher. Now, we're not going to go to $150 a barrel of oil, right? So I'm not saying that. But you could very well get a rally here in oil that takes you back up into the mid 80s, which would be a very nice, kind of boost to energy companies in the near term. And I think, and again, I think that, from a rotational basis, money, I've posted this in the newsletter over the last couple of weeks, is we go through the most oversold sector of the market, and energy's been the most oversold sector of the market like 3 weeks running. And that's going to rotate, and money's going to start to flow in there. And when money starts to flow into that sector, which it did this last week, it starts pushing these asset prices higher fairly quickly. So that's why having a good diversification, you may have a slug of your portfolio that's underperforming near term because it's temporarily out of favor, but then it'll start outperforming when other stuff is underperforming. So diversification helps support the whole portfolio and lower your overall volatility.
Right. And I mean, that is the foundational benefit of diversification. Exactly. All right. And sorry to keep jumping around here. There's just so much going on this week. There's lots of important things to talk about. So on the day we're talking, coming out of this payrolls report, the 10-year bond yield is jumping. It's up over 3%, right? So the 10-year is getting back close to a 4 handle here at this point in time. So I'm sure you're going to be getting some emails this week, Lance. What's going on with bonds? And I'm going to assume the answer is no, but is any of this recent action changing in any way you're looking at your bond trade?
No, actually the answer is no. And it's very interesting. I actually wrote a piece. Mike actually covered this. So it was interesting because Mike actually, in our daily market commentary on our website, he actually wrote a piece. I think it was here. Sorry, I apologize. It's his actual post, his actual blog post this week called "Crystal Ball. A Crystal Ball Isn't Enough," and the importance of context. And it was interesting because what he's talking about is that there's a if you go to the website and go to this article, there's this blue link right here. When a crystal ball isn't enough to make you rich, you can take a test. And what the test is that it gives you a headline, and it says, here's the headline, so you know what's going to happen tomorrow. It gives you the headline a day in advance of what happened in the markets tomorrow. So you get the headline a day in advance, and then you can select how much you want to invest. So you can do 100% of your money in stocks, or 100% in bonds, or nothing, or or you can short the market, short bonds. So they gave this to a bunch of retail investors. Retail investors lost money consistently in this test. They gave it to professional investors. They lost money, even though they knew they just didn't lose as much as retail investors. They hedged better. But even though they knew what the headline was the next day, they lost money. And the reason is that markets respond not always to just the way you think they would to headlines. So like someone's like, a war breaks out and then the markets are up the next day, or, a war breaks out and the markets are down the next day. One of my favorite examples is IBM. In 1999, stock was, they laid off 5,000 workers. I've talked about this before. The market was down that morning. By the afternoon, it rallied back, and the reason it rallied back is IBM laid off 5,000 workers. So context is really important about what's going on. But specifically to bonds, he quoted me in this thing because on September the 17th, now this was the day before the Fed meeting. And I said in our commentary, we wrote this in our daily market commentary, I said, as shown, Treasury bonds is represented by TLT are deviated from their 50-day moving average and overbought on multiple levels. I said, even with the Fed this meeting, the current setup suggests that even if the Fed cuts rates, this could be a buy the rumor, sell the news setup for bonds, which is exactly what has turned out to be the case. Now, I'm not saying I'm pressing it at all. I was lucky on this one, but the point is that the Treasury market as a function had this we had this giant run up from July to August. We had this massive run up in TLT going into the Fed rate cut. So we had priced in the very best economic outcome for the Fed cutting rates. And so when the Fed cut rates, it's like, okay, great, we got the rate cut, take profits. And now we've gone through this correction. We're now getting back to very oversold levels. We're now getting back to oversold on a MACD basis. We don't have a buy signal yet, but we've been slowly moving some of our duration, our ultra short duration, our 1 to 3 year treasuries. We moved to 5 to 7 year treasuries. We haven't moved anything out to long duration yet. But once we get a buy signal on TLT, we'll start to move that long duration out, because again, that's just a function of, bonds are simply a function of economic growth, inflation, and wages, and all those are declining on a trend. So bond prices are continuing to move higher over the next 3 to 5 years.
Okay. Yep. So when bonds were overbought back in mid-September, you were saying, hey, I think prices are going to come down, and that's going to potentially provide an attractive entry opportunity. I think you even told folks now is not the time to buy bonds. They're too overbought.
Right.
Sounds like we may be getting near the time where you will say, hey, you've been waiting to buy bonds. This is the time to do it. Correct? I heard that right. Correct?
Right. That's right. We're not there yet. I want to make sure that we can hold this support level at the 100-day and the 200-day moving average. Just technically, we need to hold around this 94, 95 level, but we're in the target zone for buying bonds, but we need to see support hold here. And you can even see today that bonds opened down fairly sharply, kind of knee-jerk reaction to the employment report. They've been buying back up all day. So, we are theoretically having a good initial test of that, kind of supported moving average.
Okay. So nobody has a crystal ball here, and even if we did, it'd be imperfect, like you just told us about. So I'm not going to hold you to this, but I'm just asking you to prognosticate. Let's say this bounces off the support that you want, and you get the green light that, okay, we're going to go in. Do you see this as like the last best opportunity to get on this bus before interest rates keep on coming down and prices keep going up? Or do you expect there to be more chop that may provide other opportunities?
You'll continue to get other opportunities. I mean, we're going to continue to just kind of grind our way higher over time, because as the Fed cuts rates, interest rates will come lower. Inflation will continue to slow as economic growth slows. So, and as wages decline, economic growth slows. So all this will continue to play in. So you'll keep getting bounces, but you can keep waiting to get in. But every time you get in, it's going to be consistently probably at a higher level. Now, look, everything can change. If for something that comes along, all of a sudden, we can identify where the and here's the key thing, right? It's where is the terminal rate on interest rates? Is it 3%? Is it 3.5%? Is it 2.5%? Is it 2%? Where is that terminal rate? That's the thing that we've got to figure out. If the terminal rate is 3%, and when treasuries get down to 3%, then that's all you're going to get out of bonds. So at that point, sell your bonds and go buy something else, because you will have maximized all of your gains in owning treasuries. If it's 2.5% or 2%, then that's where that level is. If it's 3.5%, then we're there, right? We've maximized all of our gains. So at some point, we'll figure out that we have now we'll keep coming down and testing a certain level on interest rates, and we just can't get off that level. We'll be able to determine that that's now the terminal rate, and that terminal rate will align with inflation, it'll align with economic growth, it'll align with wage growth. Everything will settle in at whatever that is. If it's 3% or 2% or 2.5% or 0.5% if you have a recession, but wherever that terminal rate is, that's the point where you go, okay, I've maximized my gain on this trade, I'm done, and now I'm going to go invest in something else. So this is just a game play at some point that will exit. It's just dependent on where that terminal rate is.
Absolutely makes sense. The terminal rate was something I actually had here for us to talk about. We're not going to be able to talk about it in depth, at least this week. I just want to note that I put it on here because more people are starting to talk about, well, maybe it's higher than we thought. Maybe it is around 3%. And it could be, who knows? We'll find out. What I find interesting about that is I remember when the Fed started hiking rates, I remember talking with you and you were like, oh, they'll never get to 3. The economy can't handle 3. Maybe 3 is now the new neutral rate. So I don't know, we'll find out. But the spirit of my question, which I'm just going to ask quickly, slightly differently, is let's say this plays out the way you think, and we very shortly bounce off of whatever support you're looking for. Would you be surprised to see the US 10-year back at 4% before this is played out?
Not at all. That wouldn't surprise me. That's about where the 200-day moving average is. We're not that far away from it right now. So, we get down to kind of this level somewhere, then, that would kind of be, kind of a decent entry point. Again, just kind of looking for, kind of where the next, kind of push up here, somewhere on rates is, kind of just continue to kind of work this pattern that we kind of, this pattern that we just kind of keep seeing kind of over and over. We kind of work through these little corrective cycles, and then we kind of work our way back up again. So, wherever this thing bottoms, I don't have a clue. Because again, there was a whole lot of money that went into chasing treasuries, so prices got 4 standard deviation. And again, this is why we talked about gold and stocks earlier, and talking about these 4 standard deviation moves. This is what you had right here. You had a 4 standard deviation move, and we talked about that on your show. I'd written about it numerous times in our newsletter. Is that 4 standard deviation move? And that's why I was saying, hey, you can't buy bonds here; they're too extended. 4 standard deviation moves always correct to the mean. It's just a function of when they do it. Now, this was 4 standard deviations on a daily basis, and just to remind you, that S&P and gold chart we did earlier, that was 4 standard deviations on a monthly basis. So moves are longer on a monthly basis than they are on a daily basis. But reversions to the mean are always going to be a reality. And then right now we're starting to trade below the mean, which means the next move will be higher to move back towards the mean.
Okay. All right. So many of these topics we could keep talking about forever. But I'm going to have to move on here. I'm getting to your trades in just a minute. A couple of topics that I wanted to talk with you, maybe we'll talk about in more depth next week, but I just want to note them because they're developments this week. One is that the longshoremen strike, right? The Gulf and East Coast strikes have been basically pushed off until January. They've, I think, negotiated a 62% pay raise over the next 5 years with these workers. They're going to keep negotiating on some other factors, but the longshoremen have basically agreed to keep working through January. So, crisis averted, at least for now. And then student debt relief is back in play. I don't know, we've talked about this at periods in the past. Both those things, maybe a jaded person could say, hey, are those done for optical reasons? Both the threat of a strike and then a quick resolution and then student loans back on the table. Are those optical things to try to help sway people's decisions to vote? I'm not going to go there, but those are material developments. We want to talk about them more next week. We can. Here's the thing I want to talk about. I had a rant that I'll push off to next week. I'll kind of make this week's rant, potentially, and then we'll get to your trades.
I have a small rant that I really want to get off my chest today.
Okay. All right. Well, we make a little bit longer than folks. Okay. So real quick. Well, first, before we get to the rants, let's get to your trades. Let's give people what they want. What's happened over the past week?
So a couple of things. One, so in our dividend equity model, we had a company called Fastmill, FAST is the symbol on that. We also previously owned Philip Morris in our portfolio. Philip Morris had a huge run over the course of like 3 months. It was up like 28% of the portfolio, just extremely overbought. So we had sold that, taken the profits in on that, but that was one of our bigger dividend payers. It paid about 4.5% on the dividend yield. Fastenal was really just struggling. We bought it. We were in negative territory for quite some time with it. It finally had a nice rally here recently with the rest of the market, got into positive territory. So we took our opportunity to take a laggard out of the portfolio, which was Fastenal, and we bought, which is Philip Morris had a correction, and it worked off some of that overbought condition. But we actually added Altria instead. Altria and Philip Morris trade, they're the same company, they're to split the company. But we actually picked up Altria instead of Philip Morris. It has an almost 8% yield on it. So it really helped kind of boost the yield of the portfolio. But gave us the same kind of exposure, that defensive play. And those two stocks kind of trade very close to each other anyway. And Philip Morris has been outperforming Altria a bit. But again, for the purpose of the portfolio, we're looking for something that's more lower volatility with a dividend yield, and a good steady paying dividend yield. And so we added Altria to the dividend equity model. In the equity model, Duke Energy and again our utility trades have just gone absolutely bonkers as of late. And we've also talked about, I think last week or week before, adding some REIT exposure to our portfolio, mortgage REIT exposure through Int'l Mortgage. Int'l just paid out a dividend. And so whenever they pay out a dividend, they have a very big dividend yield on their portfolio. So it's about a 3% dividend distribution. Well, that subtracts from the price. So we had a gain in Int'l on a capital gains basis. They paid out the dividend of 3%, which dropped the price down by about 3%. So we used that opportunity to double our position in Int'l, which we did. So we increased that position in Int'l Mortgage, and we trimmed back Duke to target weight simply because it's just gotten so far out of hand on the runs that these utilities are going to need to take a breather at some point. We still like the positions long term. We own AEP, Duke, Edison, and our dividend equity model. We own Duke and GE Vernova, which we also recently took profits in because it's up like 60% since we bought it. So we took profits in both of those and just rebalanced the target.
Okay, so you're walking your talk, you're following your practice, you're doing your gardening. Don't want to get in details of it, but I think you mentioned this before, but pretty good year for RIA, correct?
Yeah. We have good years, we have bad years, like everybody. 2021 was a great year. We performed really close. We actually tracked closer to the S&P that year. 2022, we outperformed the markets on the downside. This year's been 2023, 2024 has been, really, really good for the portfolio. So yeah, I mean, our goal is just to try to track 80% of the upside and only get 20% of the downside. And we've been doing pretty well of staying kind of within that kind of range.
Okay, great. All right. So I'm going to try to leave time here for your rant. So I'm going to keep this thing shorter than otherwise. What?
Rant is like literally 1 minute.
Okay. All right, good. Well, then we can maybe give a little bit more time to this, and then we'll end on your rant. I always like to give you the last word, so we'll have you end on that. All right. So this week, sadly saw the destruction caused by Hurricane Helene in a lot of areas that typically don't ever expect to get a hurricane, right? So we've all seen the coverage of devastation there. One of the headlines to come out of this, I'm not trying to cast aspersions, but people seem to be fairly disappointed with the federal response so far. And in the headlines around this has come the headline that FEMA is actually running out of funds, and is basically claiming it may not have as many resources as it otherwise would like to try to deal with both what's going on there, but also to have anything left in the kitty should there be other storms that happen in 2024. Where I'm going with this is this more evidence, not just of kind of the general government inefficiency that we like to rail about, but also that we've had so many of our programs overtaxed by the immigration issue. And I'm not trying to demonize any people here, but and it's not just immigration either. There's also a conversation going on that, we're sending so much of our capital outside of the country to things going on outside the country. And people, I think, are understandably asking, hey, wait a minute, why are we spending so much outside the US when there's still so great a need here domestically? So we've obviously spent hundreds of billions on the major wars outside Ukraine, what's going on in the Middle East. I think we've spent 640 million on programs dealing with the surge and undocumented people here. And I'm mentioning all this for a couple of reasons. We've talked about immigration, both the need for it, but also some of the challenges we have, currently with our very porous borders at the moment, and the big surge, and I'm just talking facts here, the big surge in undocumented workers. It's a sensitive subject. It's a triggering subject for a lot of people, but it has not just social implications, but this is a money channel. It has economic and national financial implications. And I want to be able to have an adult-sized conversation about this. So I just want to let folks know that I've been reaching out to the Border Patrol, to the U.S. Customs and Border Patrol offices. I've talked to some stations that are along our southern border. While we were talking, Lance, I just got an email response back from the head researcher at the Center for Immigration Studies, who's agreed to come on this channel. So we're going to have a conversation soon on Thoughtful Money, just about the facts on the ground of what's going on and what the economic implications of them are. This is a really interesting topic for a whole variety of reasons, but I guess one of the things I want to get your thoughts on, Lance, is this question of deploying money internationally versus domestically, right? And it's a juggling act that any administration has to try to figure out to do their best at. And I totally understand that there are lots of long-term interests of America that we have to make sure we're out there representing, in the wider world. But we do have, an increasing number of real needs inside the country here that we don't seem to be adequately resourcing. And I guess my question for you is, like, how do you think about balancing that tension between what we need to do internationally versus what we need to take care of domestically?
Well, this was my rant.
Oh.
Because it just pisses me off. Look, here's some numbers for you, right? So we've given 24 point, this is this year so far, right? So just this year, this doesn't count last year, which was several hundred billion, but 24, we've given 24 billion to Ukraine, 11.3 million to Israel. Now we're getting into countries that don't even like us. 1.9 billion to Ethiopia, 1.6 billion to Georgia, 1.4 billion to Egypt, 1.1 billion to Afghanistan, 1.1 billion to Somalia, 1 billion to Yemen, and 987 million to the Congo, 896 million to Syria. So, but we can only give U.S. citizens in a time of need $750 because FEMA's broke all of a sudden. I have a huge problem with that, and again, that doesn't mention the $9,000 per illegal immigrant that comes into the U.S. And the problem is that we have our priorities entirely screwed up with what the government's job is. The government's job, as we said before, is two things. One, it's national security. The other is infrastructure. Well, a hurricane is both national security and infrastructure. And we've got real citizens in need right now of capital. They've been devastated. Now, a lot of you listening to this video, you may have never been through a hurricane. You may have never been through a flood. You may have never lost all of your belongings and be out of your house, right? I've been through three. And I know Adam's done his fair share of stuff, but when you go through a hurricane and you literally lose everything and you're starting over, it sucks, right? And you're having to figure it out. And this is why you pay taxes. This is supposed to be the whole reason you pay taxes, the whole reason you have insurance But yet even the insurance companies are trying to come up with reasons. Well, we can't cover that because of A, B, or C reason, right?
Right. That was wind damage from the hurricane. You're only protected for water. Yeah, that type of stuff.
And this is and this is the games to get played. So, exactly what is your job and why are you not executing? This shouldn't even be a question, right? When FEMA goes, I need money. All right, here you go. I mean, we can somehow magically issue 60 billion in bonds to send money over to Ukraine. And by the way, the money we send to Ukraine, we have no idea where it goes.
Right. Yeah,
right.
The accountability is super not transparent.
We even have tweets from President Biden saying, "Hey, we're helping fund Ukrainian citizens' pension funds." Okay, what about our citizens' pension funds? Do you know what it would take to solve homelessness, to solve veteran affairs in the U.S.? You're talking a few $billion, probably $10 billion, $20 billion tops. You fix homelessness, you fix veterans affairs, you take care of our veterans. You make sure that they're healthy, well cared for, have mental, access to mental health care, all the things that they need with just a pittance of the money that we're sending overseas to countries that literally want to kill us, right? Take the $1 billion you're sending to Somalia and take the other billion you're sending to Syria and send that to the people in North Carolina and Florida and everywhere else that need it. Help them get back to where they go because they're the ones that are paying our taxes. Okay, I'm done with my rant.
Okay. And look, I don't want to diminish the importance of the force for democracy and also the long game of, hey, if we end up losing this country here, it sets off a domino effect over here. Like if we're playing the long game as a superpower, there are important chess moves you have to play that are on in other theaters. So I'm not trying to diminish that, but yeah, the point I was trying to raise, which I think you've done a good job of getting to the emotional heart of, is how do you make that determination? And it does kind of feel right now that we are there's an imbalance there that doesn't feel very fair at a fundamental level to the mass population here in the country. I also want to make sure I don't come across when we talk about the undocumented or illegal worker or illegal immigrant situation. I don't want to come across in any way of demonizing these people. I literally just heard a story of an immigrant to America, and their story, which involved, basically years of, trying to get out of a country with a horrible regime, dealing with separation from family, killings, rapes, just horrendous things that this immigrant had to get through just to be able to come to America with nothing and have to work like a dog to try to build a life for themselves here, right? And it's completely understandable why they want to be here and why they'll probably be an incredibly productive member of this society and will probably push their children to become so. But that's not every immigrant. And also, there's probably, of the 8 billion people in the world, there's probably 2 to 3 billion people who are trying to flee scenarios like that. So as Elon Musk says, we don't have a border with China and with Mexico and Canada. We have a border with the world, right? If we wanted to let everybody that wanted to come in here tomorrow, we would have multiple billions of people, coming in, and we just obviously don't have the resources or support structure for that. So it is not an anti, immigrant stance at all. It is as you and I have talked about in the past, Lance, what is a intelligent and yet as humane as possible strategy that still keeps things sustainable, both economically and societally here. So we're going to try to dig into that. All right. Well, look, it's going to be a difficult needle to thread, but we're going to try to do it here. And folks, when that interview is scheduled, I'll certainly let you know here on the program so you can watch out for it. I also want to note too, I will definitely be staying to my lane for the majority of the time and sticking to my knitting here with this as a financial and wealth building channel. But we will, from time to time, do special reports on things that are important developments in the world that also do have economic repercussions. A good example of that is the interview I just did earlier this week with Ryan Bohl, who's RAND's Mideast geopolitical analyst, and we talked about the implications of the escalation of tensions between Iran and Israel. If you didn't watch that, folks, I think it was a great discussion. We'll try to do more ones just like that, which try to be as apolitical as possible, but just try to give as much context and facts to those of us that are trying to understand what's going on, as well as what the most likely potential next steps are. All right. Well, look, if through all these emotionally charged issues, if the one that just brings you calm is listening to Lance Roberts on this channel week after week, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. We talked an awful lot about both the fact that liquidity is pouring into the system, and that may really put a bid under this market for a good long time. But you also have to be careful of the shorter term cycles. And Lance, thinking the markets might be a bit overbought here, especially given that the Federal Reserve might not be able to cut rates as much as the market expected. So if you're looking for help trying to figure out what changes you might want to make in your portfolio based upon all that, and would like to talk to one of the financial advisors that Thoughtful Money endorses, perhaps Lance and his team there at Real Investment Advice, then consider scheduling a free consultation with them by going to thoughtfulmoney.com, filling out the short form there. The firms will be in touch with you right away if you do. Lastly, just a reminder that we are now officially, the day this video comes out, just 2 weeks away from Thoughtful Money's Fall Online Conference on Saturday, October 19th. If you haven't got your ticket yet, run, do not walk to thoughtfulmoney.com/conference to lock in your ticket there. Just a reminder, if you can't watch live on the day, don't worry. Everybody who buys a ticket is going to get sent replay videos of the entire event, all the presentations, all the live Q&A. And if you are a premium subscriber to our Substack, you get $50 off of whatever the current ticket price is. Lance, thanks for another great week. I'll give you the last word as usual.
Now, look, it's we covered a lot of topics, but the big thing is just focus on what the market is doing, and don't allow psychology and emotions to override your investing discipline. And that's the one big challenge we all face as investors. And it doesn't matter whether you agree with my philosophies or not, because you shouldn't, right? You should have your own investment philosophy, your own decisions, your own design, but just make sure whatever it is that it's being data driven and not emotion driven.
All right, very well said. Well, Lance, look, thanks for another great discussion this week. I hope between now and next week, the universe spaces out the challenges it puts in your way just a little bit more. But anyways, my friend, look forward to talking to you next week. Everybody else, thanks so much for watching.